In this episode of Money Talks, Adam Dawson joins me to talk all things money management. He is the CEO of Retto Finance, a financial services provider specialising in lending services in the Channel Islands. Today, I'll be quizzing him on personal finance and we'll discuss some common questions that we've no doubt all wondered at some point in our lives. Adam, thank you for joining me today. Let's start with an introduction. So can you tell me more about Retto Finance and your role there?
Yes, morning. So Retto Finance is a local business based here in Jersey. We are, I guess, what you would describe as a non-bank lender. So a specialist lender that provides funding to local residents and businesses. But we're not a bank, so we don't take deposits and you can't have current accounts with us. We specifically lend. That's what we do. The business was born out of, I did a management buyout of the business I'd originally set up in 2016 for Shawbrook. So Shawbrook's a UK challenger bank. We set up a business in Jersey in 2016 as a subsidiary of the bank, and then in 2019 I did a management buyout. So it's now a locally owned and managed business, of which I'm the CEO.
Great. Let's start with a big one. So why, in your opinion, is budgeting important?
At its very simplest level, budgeting's important because all of us kind of have a responsibility to not spend more than we have. You know, that can be a pretty slippery slope. If you're constantly spending more than you have or you earn, then ultimately, you know, that's going to put you in a position of debt, which you might not be able to get out of that easily. So, you know, approaching your own personal balance sheet, i.e. what you earn versus what you spend in a kind of sensible and grown up way is pretty important.
Yeah, absolutely. So considering the importance of it that you touched on, how can we budget? Are there tools available to do so? What tips can you share?
So I think, there are lots of resources available online. You know, you only have to look in Google and you'll find those. I mean, I guess I would say be a bit careful about what tools you use. So go to a trusted source. So for example, the Citizens Advice Bureau, which exists both here and in the UK, provides some good online budgeting tools. And there are other kind of non-profit organisations that do the same thing.
Yeah.
So there are online tools that you can use. But to be honest, it's not really that complicated. You know, as long as you can kind of manage a fairly basic Excel spreadsheet, then, you know, writing down what you have coming in, what you have in savings and what you have going out is a relatively easy thing to do. I think, you know, there are some basics that you can adopt. So the first thing I guess I'd say is, you know, be honest.
Yeah.
So don't kind of try and come up with a budget that's aspirational. It needs to be factual.
Yeah. So,
you know, what do I have coming in every month? What do I have in terms of savings? Depending upon what stage of life you are, you know, if you're, for example, if you're very early on in your career, you know, understanding maybe what's coming down the track a bit. So, you know, for example, if you're young and you're perhaps living at home still and you might not have any rent to pay, that's great. But that's likely to change. So what are you doing to prepare for that and being kind of alive to that? I mean, there's an interesting, and if people go online and kind of search this, you'll find there's a kind of interesting methodology called the 50-30-20 rule.
Oh yeah.
And essentially what that's about is saying, if you take 100% of your income, whether that's income that you earn, income from savings or investments, whatever it is, take 100% of your income and then allocate 50% of it to stuff that you need. So things that you need are, you need to be able to eat,
Yep.
You need to be able to live. So paying for rent, mortgage, food bill, utilities, light, heat, that kind of stuff is all stuff you need. So from what you earn, 50% of what you earn should be focused on stuff you need. Mm-hmm. The 30% is then in the want category. So I don't need it, but I maybe want it. So I want to go out for dinner, or I want to buy that new suit, or I want to go on holiday. They are not things you need to do. So try and allocate 30% of your income to the want category. And then the last 20% is really about saving. So, a good rule of thumb is try and save 20% of what you earn. Now that possibly sounds like quite a lot, and it will vary at different stages of life. But I think if you approach it from that kind of standpoint, you put yourself in a relatively strong position. The flip side, the alternative is you don't do that. Your money comes in every month and you spend it all, and you end up spending it on stuff that you don't really need. And we've probably all been in situations where we've done things, gone out on a bit of a spending spree, and then, you get this whole buyer's remorse thing of, a week later when you're looking at your bank account, it's got no money in it, thinking, well, I didn't really need to do that. That was probably a bit reckless. So although it sounds a bit boring and grown up, it's a fairly good way of trying to allocate your income every month to spending. I mean, the other thing I'd say about savings is it's perhaps not a very popular subject. People think savings, and that's all a bit boring. I want to live for the moment, I can't take it with me. I just want to spend what I've got and have a good time, which is fine until something goes wrong.
Yeah.
So, another thing I'd say is if you kind of adopt this 50, 30, 20 thing, and you think about how much money you want to try and save, irrespective of anything else which may be going on. So, you might be saving for a deposit for a house. You might be saving for a down payment on rent for a new apartment. Any number of things you could be saving for. But as a general rule, being able to save 6 months worth of income is quite a good benchmark to aim for, because you never know what's going to happen around the corner. And if you know that you've got that buffer of 6 months worth of income, so if something happens, whether that's you lose your job, or you're ill and can't work, or if you're self-employed, you injure yourself and you can't earn, having that buffer of, right, well, I know I've got 6 months to fix this, stops the wheels coming off.
Yeah.
If you don't have that sort of buffer, things can start to derail quite quickly, and you put yourself in a way more stressful situation. So in the sensible moments of regular income coming in, thinking about putting something away to build up that 6 month buffer is a really good idea.
Yeah, just kind of looking after future you in that respect.
Yeah.
So moving on to what many might consider more complicated areas of finance, could you talk me through the different types of borrowing?
Yep. I mean, I would say this, wouldn't I? Because it's what I do for a living, but it isn't really that complicated. Fundamentally, you have a borrower and a lender in this arrangement. The lender is the person with the money, and the borrower is the person borrowing the money. How that happens can appear sometimes to be a bit complicated, but fundamentally they're all fairly similar. So, if you think about kind of the most expensive purchases you're going to make in life as you go through life, if you're going to buy a house, that's going to be number one.
Yeah.
For most people, that is the most money they're ever going to spend on one thing. So if you're going to buy a house, then typically you buy that by way of a mortgage. And all that really means is you're borrowing money to buy your house, and what you're providing in return to the lender, whoever's providing the mortgage, is security, and the security is your house. So, at its worst, what that means is if you don't pay, then the lender has the ability to take possession of that asset.
Yeah.
So they can take possession of your house and sell it to settle their debt. So that's what you would call secured debt, because it's secured on an asset. There are other types of secured debt. You can secure on all sorts of things. You can secure borrowing against share portfolios, investment portfolios. that can get a little bit complex.
Yeah.
But fundamentally, a secured loan or a mortgage is what you're going to use to buy a house. Now, typically, because from the lender's point of view, the risk to them is relatively low. They've got security in an asset which is likely to appreciate over time. So, okay, we're in an interesting time at the moment in the property market where perhaps property price has been little bit depressed. But we're pretty lucky here across the islands where, we've got a limited amount of space, and therefore typically property prices don't fall that much over the long term.
Yeah.
They rise. And so from the lender's point of view, the risk of them losing their money is relatively low, and therefore the interest rate that you're likely to pay is probably as low as it's going to be.
Yeah.
So there's this, people might have heard the expression rate for risk. So lenders like us will lend money at different rates of interest depending upon what we perceive the risk of the borrower to be.
Yeah.
And in the case where you've got some security, your risk is reduced, and therefore interest rates typically lower. If you're looking at a mortgage for the first time, it can be a bit confusing, I guess, because you'll start to come across things like loan to values. The rate of interest varies depending upon how much you want to borrow versus the value of the property you're buying. Loan to value is simply a way of saying, if a house is worth £100,000 and you need to borrow £90,000 to buy it because you've got a £10,000 deposit, your loan to value is 90%.
Right.
And typically, back to my point about rate for risk, the higher the loan to value, the higher the interest rate's going to be, because the risk to the lender is increased the higher the loan to value is.
Yeah.
And so what you'll see is if you go and look locally at mortgage providers and what they'll provide in terms of interest rate, you will see it varies depending upon what the loan to value is. So again, back to my savings point, the more you can save if you're looking to try and buy a house, the bigger the deposit, the lower the loan to value is, and the lower the interest rate is. So you can see by being a bit sensible and lowering your loan to value, you typically can borrow money cheaper.
Yeah.
So that's mortgages. Another big thing that people, I guess, will be thinking of buying. What do we spend a lot of money on in our lives aside from houses? Cars.
Yeah.
So pretty common for people to, both locally here and in fact across Europe, pretty common for people to fund buying cars, whether they're new or used. So having the ability to borrow the money to buy a car is a fairly well-trodden path. That borrowing can be unsecured or secured. The most common way of doing it, people will see, is what's called hire purchase. So you want to buy a car, you might be asked to put down a relatively small deposit, 5 or 10% of the value of what you're buying, and then you fund the rest through a hire purchase agreement. And essentially what that's saying is you're using the borrowing to pay for the car, and the lender will be taking security in that car. Mm-hmm. So back to my point earlier about security, you are giving the lender security in that vehicle. So if you stop paying the loan, then potentially they have the ability to come and repossess the car.
Yeah.
So again, the rate of interest tends to be a little bit lower. You can use unsecured borrowing to buy cars and other assets. Might be a little bit more expensive. At Retto we offer both options, and that's primarily because sometimes people don't want to offer security in the car, or they might change the car very frequently, or they actually might not know what car specifically they want to buy. So actually what they want to do is get a loan, know how much money they've got, and then go out shopping with it.
Yeah.
there's potentially a view that, if you walk into a car dealer with cash in inverted commas, that you might get a slightly better deal. And so some people prefer to do it that way. So you can do it either way. So buying cars, hire purchase, personal loan, secured or unsecured. And then people will be familiar with the idea of borrowing a personal loan. Now that can be for all sorts of stuff. And depending upon, whether you're a consumer or a business, if you're a consumer, you might be looking to borrow to do some home improvements to a property, or you might be looking to borrow to fund a big life event, a wedding, for example, or you might be wanting to consolidate some existing debt, which is something I'll talk about in a minute, because I think that's quite a hot topic at the moment. So typically those personal loans are unsecured. So there's no security on offer. They're available from a whole range of places. People like us, they're available typically from the banks too, and they're certainly from our perspective, they're a very quick, convenient way of people getting access to liquidity. If you're a business, we offer very similar products. So businesses want to buy cars and vans. So hire purchase exists as a product in that world. Businesses also can access unsecured lending, which can be for all sorts of things: business expansion, stock acquisition, all that kind of stuff. So cash flow that helps the business continue to grow and expand is quite critical.
Yeah.
I mentioned consolidation loans, which some people will be familiar with, I guess. I think one of the other types of borrowing which we probably all do is credit cards.
Yeah.
So credit cards been around forever, very flexible and easy means of borrowing money. Important to understand that you are borrowing money though. Mm-hmm. You walk into a shop and you tap with your credit card. That is borrowing money.
Yeah.
Now, if you're really good, you do that through the month, and then at the end of the month you get a bill and you pay that bill off in full. And therefore you don't pay any interest, because that's the way credit cards work. If you pay the bill off in full within the time allowed by that provider, you won't pay any interest. So actually that is a very efficient way of borrowing. Mm-hmm. Particularly if you've got a large purchase that you might have saved up for. Often, actually, you can give yourself a bit of free, in inverted commas, credit for a period of time.
Yeah.
By using a credit card. It also gives you some additional protection. So there's some additional protection in the law, which means that if something were to go wrong with the product you're buying, you have the ability to claim from the credit card provider.
Yeah.
If you don't get any joy claiming from whoever it is that's provided the product to you. The downside of credit cards is, because they're so easy, it's very easy to run up large bills, and then the end of the month comes and the bill comes and you think, well, I haven't really got enough money to pay that off, so maybe I'll just pay a bit of it off.
Yeah.
What then happens is you start getting charged interest on the balance that's left, and typically those interest rates are quite high. Mm-hmm. So it's fairly common to see credit card interest rates that are north of 20%, 30%, 40%, 50% interest.
Wow.
Now, the problem with that is that if you're trying to work to a budget, so back to my very first point, don't spend more than you earn. If you start to rack up, reasonable sized credit card bills, actually what's happening is you're spending a lot of your income every month trying to service that debt. Yeah. Which is interest. You're not reducing the capital you owe, you're simply treading water. Mm-hmm. And, that's not a great place to be. And kind of the problem can get a bit worse because, people think, well, I've got that credit card, but I've maxed that to the limit. But I really want that thing over there. So I'll go and get another credit card and I'll do the same thing again. Mm. And before you know where you are, you've got a few of them and those interest bills start to rack up. So the idea behind a consolidation loan is it's a way of trying to improve your debt position. So if you've got a few credit cards, you might have an overdraft where you're paying typically quite high rates of interest. Being able to put all those together and say, well, do you know what? Across 3 credit cards and an overdraft, I've got £10,000 worth of debt that I've built up. I really need to try and get out of that. A consolidation loan can be a good way of doing that. So you come to somebody like us. What we do is we lend you the £10,000. We pay the credit cards off for you. And you pay us one monthly payment every month, typically at a much lower rate of interest than you'd be paying on the individual credit cards that you had. And you're paying it for a fixed period of time. So, what we try and say to people that we talk to is, okay, you can do this, but you need to then give us a bit of a pinky promise that you're going to cut the credit card up and not go and use it again. Because it's a way of getting yourself out of that debt situation. You might take that loan out over 2 years, 3 years, 4 years, 5 years. But at least you know that if you pay that payment every month for that period of time, you clear the debt, and you're not trying to run very fast to service interest. You are paying down the capital over time.
Yeah.
So, lots of different ways that that people can get access to borrowing. I guess the other thing I'd say is, I think we're fairly fortunate here across Jersey and Guernsey. Access to this type of credit is quite good across a number of specialist lenders like us, the banks, so a number of providers. Plenty of people that you can talk to. Kind of golden rule is don't borrow what you can't pay back.
Yeah.
So back to the budgeting point, sit down and think about, what do I earn every month? What am I spending on the things I need to spend money on? Well, debt servicing will be one of those things that you need to spend money on, and make sure you budget effectively.
Yeah.
To be honest, we although I say that, we wouldn't rely on people to do that, and people will be familiar with the idea of having to go through an affordability check. So whether you're getting a mortgage or a loan from somebody like us, we will look at what you earn, and we will look at what you spend, and we will try and give you some advice around what we think you can afford versus what you might think. And those two things might be different, but that's done with every good intention to make sure that people don't borrow money that they can't afford to pay back.
Yeah, absolutely. I think it's really interesting, your point about consolidation loans, because before this, I would not have thought that getting a loan to pay off loans doesn't sound like a great idea. It sounds a bit like a domino effect, but your explanation shows it's a bit more strategic than that. It sounds. So it's really, really interesting to have that insight. So moving on to something that is very important, taxation. So having an understanding of taxation is obviously really important when dealing with finances. So can you share more about that?
So I think, listen, what's the expression? There's only two things in life that are definite: death and taxes. We all, if we work or earn money, have to pay tax. That is the way the world works. But understanding at a basic level what that looks like, I think, is quite important. And it's important because, often there are more tax efficient ways of borrowing, and there are more tax efficient ways of saving. So, depending upon where you are in your life, so a good example would be, if you're early on in your career, you typically at that stage have quite high disposable income. Back to my living with mum and dad. If you're living at home with mum and dad, and you're not perhaps having to pay rent, or you're not paying very much rent, you typically have quite high disposable income. There's a tendency to think, oh, great, well, I've got a job now, I've got loads of money to go and spend, so I'll be off out every weekend in town spending it. Actually, saying to people at that stage of life, have you thought about a pension, can sometimes sound, a bit too grown up. But actually, I'm not a pension expert. I'm not here to talk about pensions, but pensions as a way of saving is typically a fairly tax efficient way of saving, because if you make a pension contribution to a recognised pension scheme in either Jersey or Guernsey, number one, you might find that your employer has some sort of match scheme where if you join the pension scheme, you might contribute something, they might contribute something. That is in effect giving you a pay rise. The other thing is that contribution that you make to that pension is paid out of your gross income, not your net income. So it's paid before you've paid tax. So it's a far more efficient way of saving than getting the money paid into your bank account, which is paid net after you've paid the tax, and then using that net income to save from. So that's an efficient way of saving money, and important that people understand that difference. The other thing is that if you think about again what stage of life you're at, you might be later on in life, you might be planning your retirement. So thinking about what you need to earn in retirement, what you have in savings, what you have in borrowing, when you're going to be able to pay that borrowing off, and relating that back to, kind of what tax you're paying. Typically later in life, that's when you're going to be paying the most tax, because that's when you earn the most. And normally, the more you earn, the more you pay in tax. That's just the way it works. But being a bit alive to that is quite important, because if you are back to the early on in your career, often at that stage of life, your income rises quite quickly relative to your entire working life. Normally people will start a job, grow through that role, develop their career, earn more money, and that kind of tends to plateau later in life.
Yeah.
Now, certainly, the way taxation works in Jersey, for example, you pay a percentage of tax based on what you earn. It's always useful to try and be on the front foot a bit with that, because otherwise there's a bit of a danger that for example, you might start a job, you might start earning some money, and then you've done really well, and at the end of the first year you get a big promotion and you earn a load more money, and you don't tell the tax authorities, you just carry on paying tax at the lower rate you were paying last year. And then at the end of the year, when you have to do your tax return, the tax authorities will say to you, well, actually, yeah, but you earned, 10% more this year than you did last year, so we're going to tax you more. Now you've got a bill to pay. Whereas if you told them up front, they would have adjusted it and you could have paid throughout the year. So back to my kind of be sensible with your budgeting, it's not usually very sensible to kind of stick your head in the sand and think, well, I don't really know how this whole tax thing works, so I'm just not going to say anything. Being upfront and explaining to the tax authorities what your position is usually, quite valuable in terms of being able to plan and not have to come up with a chunk of money all in one go.
Yeah, that makes sense. And just coming back to your point about pensions and telling younger people to save for it, I know exactly what you mean in terms of, I don't want to think about this right now. I've just got my job. I'm just turning into an adult sort of thing. But I think your explanation of, it's effectively a pay rise with the way it's taken from an employer scheme, for example, is a really good way to kind of emphasise the importance of it and the benefits of it as well. So
there are loads of, people can go online and there's loads of calculators you can use online. But most people would be quite surprised at how, if you start saving for something like a pension or some longer term type of saving product, the earlier you do that, the better. And it makes a huge difference. So, what you don't want to be doing is you don't want to be, coming towards retirement and being in a position where you're starting to think, well, I wish I'd started saving for retirement a bit earlier. And I wish I'd kind of managed my borrowing a bit better, because now I'm looking down the barrel of retiring with not as much income as I thought I was going to get and a bit more debt than I thought I was going to have. So just being a bit sensible about that is usually a good thing to do.
Yeah, can't go wrong.
Typically major life events are the points at which your own personal financial situation comes under the most amount of scrutiny or pressure. And, that could be any number of things. That could be, you're starting out on your first job. You're starting to perhaps earn some income and having to pay for stuff yourself as an adult. You might have a car. That car needs to be insured. You've got to pay for the insurance. It's got to be maintained. You've got to pay for the maintenance. So being able to plan for that sort of thing comes back to my point about we need to budget for that sort of stuff. You know how much the insurance is going to be if you've got a car. Well, figure out what that is a month and then put that into your budget for the month. Through to then maybe you're thinking about moving out of home and living on your own or with a partner. Are you going to rent? Are you going to buy? What are the costs associated with that? So planning for that up front. Most people can't just suddenly decide, right, I'm going to buy a house. They need to save for a deposit and for the stamp duty and for the legal fees. So, planning for that in advance is pretty important. And then as you go through life, if you're having children, children can be expensive, right? Childcare is expensive. It goes through various stages. You might have a bit of a spike at the beginning where you're having to fund nursery education, for example, which is typically quite expensive. Kids leave nursery and then go to school. Are you considering paying for schooling? What's that going to cost? Are you not going to pay for schooling? Kids then go through school and maybe they want to go to university. As people will know, unfortunately here, we don't have access to the student loan scheme that, for example, UK students would have. So parents in Jersey and Guernsey have to fund children through university. Now there is some government help for that, depending upon what you earn. But again, planning for that is pretty important. You don't really want to be in a situation where a child suddenly says, "Look, I really want to go to university and do this degree," and as a parent, you can't say yes to that because you can't afford it.
Yeah.
And then, going through life, moving house, moving perhaps to bigger houses as the family grows, all those things are things that you kind of need to plan for. And then ultimately, you've got to plan for when you're not working. What do you want to be doing in retirement and what's that going to cost? So, unfortunately, again, it sounds a bit all boring and grown up, but planning for these things is way more sensible than creeping up on you without you realising.
Absolutely. It seems like there is always something to save for, always something to manage your money well for as you navigate life. That's definitely what I've taken today, is to be sensible, get ahead of it, and don't bury your head in the sand.
Yeah.
Well, thank you so much for joining me today, Adam. It was really great to chat with you and talk about these really, really important topics that I imagine some people have wondered about, do need some guidance and advice about. So thank you for sharing your insight today.
Thanks very much.